Hi there. If you mix building site electrical work with household jobs, this guide explains when CIS may and may not apply.
An electrician pulling heavy-duty cable through a commercial construction site faces a specific set of physical and logistical challenges. That same electrician, working the next day in a finished residential living room, uses entirely different tools, materials, and safety protocols. But the sharpest difference between these two jobs has nothing to do with the tools. Imagine our electrician completes both projects and bills exactly £5,000 for each, two identical invoices. For the commercial job, the contractor pays the invoice and £4,400 lands in the electrician's bank account. For the residential job, the homeowner pays the invoice and the full £5,000 lands in the account. Despite a $600 difference in the cash deposited that week, the final tax liability owed to HM Revenue and Customs for both of those jobs is exactly the same. Welcome to a masterclass on tax strategy, presented by Atlas Tax Advisors. If you are a UK sole trader electrician operating a hybrid business model, mixing commercial site work with direct domestic jobs and earning between £50,000 and £90,000 gross, this breakdown is for you. With the Making Tax Digital mandate activating in April 2026, understanding exactly how these two money trails diverge is no longer optional. Treating these two distinct cash flows as a single, uniform tax system is the primary reason hybrid tradesmen run into severe liquidity crises and heavy HMRC penalties. We start with the commercial side and the Construction Industry Scheme, or CIS. This scheme legally requires contractors to deduct tax at source from subcontractors on B2B construction operations. It entirely excludes direct work for private homeowners. Let's look closely at that £5,000 commercial invoice. This diagram maps the money flow. A £5,000 invoice splits into two distinct tracks, £3,000 for labor and £2,000 for materials. Under CIS rules, the 20% deduction applies strictly to labor. So £600 is siphoned off the $3,000 track and sent to HMRC. The £2,000 materials track bypasses this deduction entirely. The remaining £2,400 in labor funds recombine with the untouched £2,000 in material funds. This leaves a final net deposit of £4,400 actually hitting your bank account. Having £600 withheld at the source keeps you compliant, but it instantly starves your business of immediate working capital. You haven't lost this money permanently. The contractor gives you a deduction statement, and that £600 sits as an advance credit against your future tax liabilities. However, CIS effectively forces you to prioritize HMRC's tax collection over your own ability to buy stock or upgrade equipment this week. Now, let's trace the exact same £5,000 job valuation through the B2C domestic track. Because a private homeowner is the end user and not a commercial contractor, they fall entirely outside the scope of CIS. They pay the gross invoice amount in full. You receive the full £5,000 upfront, providing excellent immediate liquidity for your day-to-day operations. The trade-off is total responsibility. 100% of the tax burden now rests on your shoulders. You must manually ring-fence and save the correct proportion of that £5,000 to cover your year-end tax bill. This brings us to a critical professional tip. Understanding how these two systems differ exposes a devastating administrative error made frequently on the B2B side. If you submit a commercial CIS invoice but fail to explicitly itemize your materials separate from your labor, the main contractor is legally permitted to apply the 20% deduction to your entire invoice total. That turns a £600 deduction into a £1,000 deduction. Your net deposit drops to just £4,000.
A totally unnecessary £400 loss of immediate capital can easily disrupt your weekly payroll or delay payments to your own suppliers. In a hybrid electrical business, your survival cash is directly dictated by administrative precision on your invoices. That precision becomes a legal requirement with the Making Tax Digital for Income Tax Self-Assessment mandate, which activates in April 2026. The trigger point for mandated compliance is £50,000 in qualifying combined income. This is where CIS subcontractors make their most common and most costly accounting error. HMRC calculates your threshold using your gross combined turnover before any CIS deductions are taken out. This graph illustrates the danger. Tracking only the physical net cash hitting your account creates a false sense of security. The invisible 20% already taken by HMRC must be added back. That missing cash pushes your true gross income right over the red threshold line. This exact same gross calculation trap applies to the £90,000 VAT registration threshold. Missing these thresholds triggers immediate consequences. You will be legally mandated to submit quarterly digital updates and face heavy financial penalties. Ignoring the withheld 20% in your internal bookkeeping guarantees you will trigger MTD non-compliance the moment the 2026 tax year begins. At the end of the tax year, your B2B gross income and your B2C gross income merge into a single calculation to determine your true profit. That final profit figure dictates your income tax and your national insurance. For the 2026 to 2027 tax year, the national insurance structure has updated. A major change for sole traders is the abolition of the mandatory weekly Class 2 national insurance flat fee, completely removing that administrative burden. Your liability is now determined by Class 4 national insurance. The first £12,570 in profit sits in a 0% liability zone. This chart outlines the brackets. The primary Class 4 rate is 6%, which applies to all profits between £12,570 and £50,270. The upper Class 4 rate drops to 2% on all profits exceeding £50,270. Once your total tax and national insurance bill is calculated, those CIS deductions you suffered throughout the year finally benefit you. The £600 withheld from your commercial invoice way back in the spring acts as a direct prepaid credit against this final unified bill. CIS is not a separate extra tax. It is simply an early mandatory installment plan on your unified annual tax liability. The hybrid business model offers excellent risk diversification, provided you manage the mechanics correctly. Your domestic work provides superior, immediate working capital to keep your business agile and well-stocked. Your commercial CIS work provides steady, high-volume contracts and prevents massive, unexpected tax shocks at year-end by prepaying your liabilities. To protect this balance, you must maintain absolute separation in your bookkeeping. Use distinct ledger codes for gross CIS income versus gross domestic income. Transition immediately to MTD-compliant software. This automates the calculation of your true gross turnover, preventing threshold breaches before they happen. Navigating this fragmented tax landscape requires specialized, trade-specific support. Contact the team at Atlas Tax Advisors. We optimize hybrid structures, manage gross payment status, and ensure total compliance with the VAT domestic reverse charge. Please note, this video provides general guidance based on 2026-2027 UK tax legislation and does not constitute formal financial advice. Mastery of the hybrid model transforms tax compliance from a confusing liability into a strategic, competitive cash flow advantage.